China's economy is not crashing. It's worse than that.
U.S. oil isn't the only thing China is throwing overboard. They are selling U.S. bonds, that's U.S. debt, while at the same time they have their own increasing debt problems as the Chinese economy is slowing down. Some are reporting China's local governments are under a pile of debt amounting to roughly 40 trillion yuan. That's about 5.8 billion U.S. dollars. An S&P analyst was quoted as saying the potential amount of debt is an iceberg with titanic credit risk.
There has been a debt explosion in China over the past decade. After the 2008 financial crisis and the stimulus that they used to respond to that, which never really ended.
The tariff situation has created a very bad potential problem for China. Fourth quarter this year, potentially a big way first quarter. If this ramps up January 1st, the Chinese economy will be hurting very badly.
The latest Chinese economic statistics are, for several of them, the lowest in some time. Starting with real GDP at just 6.5% in quarter 3 2018, it's the slowest pace since the first quarter of 2009. That's not good, especially for a statistic of such dubious practices, often specifically crafted to be the best it can be. When it comes to estimating China's total outstanding debt, there has long been confusion about the real number, with most putting the debt GDP at around 250%, while the IIF last year calculated China's debt load as high as 300% of GDP. Now, China watchers can add another about 40% of debt GDP to the total because, according to S&P, China's local governments have accumulated 40 trillion yuan, that's $5.8 trillion or even more, in off-balance sheet debt, suggesting the already record surge in defaults is set to accelerate further. The potential amount of debt is an iceberg with titanic credit risks. S&P credit analysts wrote in a report Tuesday, Bloomberg reported, with much of the build-up related to local government financing vehicles, which don't necessarily have the full financial backing of local governments themselves. $22 trillion in debt is held by Chinese state-run enterprises. This is just one sector of China's economy. China's household debt increased from 44.8% of GDP in January 2017 to 53.2% of GDP in October of 2017. That's an 8.4% increase in debt to GDP in just 9 months. Household debt stands at $6.5 trillion. Chinese government debt of 48% of GDP is about $6 trillion. So all up, China is holding about $35 trillion in debt that we know of at present, with an economy of $12.2 trillion. China already doubled its debt as a percentage of GDP in the previous 10 years. To do so again, just to keep artificial GDP targets, is foolhardy and a recipe for disaster. China would take its debt levels towards 500 to 600% of GDP and well over $60 trillion to maintain current GDP growth on current trends. Clearly, this cannot occur, and it won't. World markets will react long prior to this, let alone China's internal markets. The government would need to create even more debt to bail out these enterprises or risk a complete collapse of the economy and a depression. This is the real story in China, and therefore for everywhere else. The real danger presented by these statistics is not imminent crash, but rather the total disappearance of any upside potential. Even during 2017, the narrative about globally synchronized growth continued as a future property. The global economy in that year was clearly better than it was during the worldwide downturn 2015 to 16, an easy comparison, and that was expected only as the first step toward meaningful acceleration and then recovery. Where economists and central bankers jumped the gun was in assuming that 2017's improvement was the only evidence they needed for these complete expectations. As it turned out, as it always turns out, changing from minus to plus signs is a necessary condition for better days, but not by itself a sufficient one. Acceleration requires momentum, among other factors, and momentum is derived from conviction. The best days of 2017 never really had that. The absence, perhaps clearest in China, particularly the hollow rebound of CNY, which somehow lacked capital inflows. Everyone kept waiting for the Chinese to zoom on ahead and bring the whole up with them. Meanwhile, in China, they kept waiting for the rest of the world to take the lead, so as to pull them out of their funk. That's been the thing about global growth since 2011. Everyone expects that someone else will solve their economic problems for them. Momentum will arrive, you see. It'll come from somewhere else. Without a clear path to that next step toward recovery, doubts multiply rather than abate. What was for a time mild opportunity, reflation, sinks back toward the malaise of liquidity risks that over time can only return to self-reinforcing. This is what's significant about China's numbers today. They practically declare reflation dead and gone. There is no upside left. What you saw in 2017 was the best of it, and it wasn't very good. It was, in honest analysis, not really that much better than 2016 at all, certainly less than the prior peak. The rest of the statistics bear this out. Nominal GDP, perhaps a more appropriate measure of China's economic conditions, decelerated yet again in quarter 3. Year over year, it rose just 9.6%, down from 9.8% in quarter 2, and a peak of 11.7% set way back in quarter 1 2017. The more time passes without clear acceleration, the more it has to sink in, everywhere but Washington, D.C., that this really is a rising dollar L. The world economy has never recovered from the 2011 euro-dollar crisis, the squeeze. The system broke in August 2007, created all sorts of devastation immediately thereafter. But for a time in 2010 and the first half of 2011, it looked like recovery was at least possible, if unusually weak. Economists, incapable of appreciating the global monetary system for their modern practice of neglect, mistook 2011 for a lack of sufficient time. They crafted monetary policies with no money in them, so as to buy the financial system, enough of it, thinking that would be the magic elixir. Instead, time has proven beyond all doubt that 2011 was the last stand for recovery. It just isn't possible so long as the global reserve currency, the euro-dollar, not dollar, remains dysfunctional. There can never be enough momentum to escape. Opportunity surrendered by this neglect. The more Chinese statistics in particular show this to be true, the more it will spread and eventually become self-reinforcing again. In certain places, it may have already. The rest of the data follows along this way, not crashing, but what may be worse as the end to any upside. Chinese industrial production rose just 5.8% year over year in September, the first month below 6% in 2.5 years, going all the way back to the trough of the last downturn in February 2016. As noted at the outset, there can be an inclination to make more out of that comparison when, for now, it simply confirms there just isn't any recovery. Along those lines, it stands in sharp contrast to sentiment which, even in China, had gotten way ahead of economic reality. It's another element of 2017, and globally synchronized growth that is being slowly, steadily undone in 2018. Sentiment has proved a worthless indicator and well beyond the other side of the Pacific Ocean. Retail sales was practically the lone bright spot, which merely means that there wasn't as much slowing as there had been. Rising 9.2% in September, it was the fastest pace in 5 months, but still materially less than the 10% plus rate that prevailed 2015 forward. Fixed asset investment managed to tick a little higher last month as private capex remained steady while government investment rebounded slightly. Overall, FAI was up 5.4% on an accumulated basis year-to-date compared to August's record low, 5.3%. Private FAI, also on an accumulated basis, stayed at 8.7%. State-owned FAI gained 1.2% last month compared to 1.1% the month before. China's economy is not crashing. It is worse than that. It is slowing, and from an already weakened level. The Chinese system did not actually recover from the last downturn, despite now 3 years' distance. What these numbers show is that, like the euro-dollar system, there is now very little chance that it ever will. It may not seem like much compared to a full-blown breakdown, but pretty conclusive evidence for a worldwide, multi-year, or should it be decade, L should be terrifying. A world without opportunity is a far more dangerous one than a world only temporarily stripped of it. The V can be scary, but only on the way down. The L is, well, I think we're going to find out.